Hi, my name is Megan Thompson, and today I'll be introducing the topic of Converging U.S. GAAP with IFRS and the discussion that it's a better option than converting directly to IFRS. As we all know, the United States is currently subject to U.S. GAAP, which is generally understood to be a rules-based accounting standard that is less subject to interpretation. Now, in 2002, IASB was established to develop IFRS. IFRS, as we know, is the International Financial Reporting Standards, which is a new global accounting standard. Since the creation of IFRS, approximately 120 nations require IFRS for domestic listed companies, with about 100 countries which have fully conformed to IFRS. Now, being able to conform those GAAP industries to IFRS makes it easier for comparisons because businesses can present their financial statements on the same basis as their foreign competitors. The debate today is whether it's a better option to converge U.S. GAAP with IFRS or convert directly to IFRS. The reason why this topic is important to the accounting profession is, as I would really like to show, is the KPMG. They stated on their website that there are many reasons why the U.S. may want to consider adopting IFRS, either as a substitute for or to complement the U.S. GAAP standards. 1. IFRS is relevant to many companies, everybody, big, small, public, and non-public. Whether they are dealing with anybody internationally, IFRS is relevant to those companies. It's also important to be able to access the international markets that require financial statements prepared in accordance to IFRS, both mid-size and larger firms. To begin with the mid-sized firms, if they're unable to generate investor or capital in the U.S., then they'll need to be able to access those international markets. Now, for the larger firms, when they are needing to able to seek into getting those untapped markets, they need to be able to get the information from the international markets. Now, it is beneficial for U.S. companies that also have foreign investors, which attract foreign capital or that have foreign operations overseas. And if a company is acquired by a foreign company that prepares IFRS financial statements, that knowledge is needed. There are 3 assumptions that I would like to go over that occur because of the change to IFRS. First is the cost. The cost of implementing the change to companies and figuring out if they outweigh the benefits is important for everyone. Let's begin with the tax consequence of using FIFO, since IFRS does not permit LIFO, which is last in, first out. Second, continued costs of preparing financial statements for tax purposes. They will always need to be retrospectively fixed because of the differences in the accounting standards. Next, the retraining and re-educating currently practicing professionals will always be a cost incurred. Finally, the U.S. GAAP and IFRS differ on what could be included on their financial statements. So how the information is presented and being able to accommodate that transition to a new accounting standard requires existing computer systems, being able to maintain the accounting records that they have to upgrade or that the new systems are being able to purchase. Companies also need to be able to maintain the new systems and legacy systems until the usefulness of the information expires from those legacy systems. In addition to the one-time cost of converting to IFRS, there's going to be ongoing costs similar to remaining on U.S. GAAP, just as we know today. Secondly, we'll talk about the education. So the IFRS changing over is going to be needing implemented education for everybody. That includes investors, stakeholders, public accountants, and management. There was a study done in 2012, which was 10 years after IFRS was created, that the SEC did based on the incorporation of IFRS. They found that the U.S. investor knowledge of IFRS ranged considerably, with many unfamiliar with IFRS. So 10 years later, a lot of companies didn't have to deal with the overseas implementation of IFRS, but many were unfamiliar, and that is why education would be considered in both converting and converging with IFRS. Finally, we'll talk about the retraining. So retraining, I want to talk more about on changing it from a principle-based approach rather than the rules-based. IFRS, as we all know, provides fewer detailed rules than the U.S. GAAP according to the AICPA's website. U.S. GAAP is considered to be rules-based that relies on specific guidance and a list of detailed rules on accounting principles and how they should be applied. We all know that. Now, according to the article discussing principles-based accounting standards that I read, rules-based accounting standards do not address all those unforeseen situations, whereas principle-based standards provide a framework for the decision-making. So it's the spirit of how rules should be interpreted and followed, rather than just the rules. So if in doubt about how to apply the principles, IFRS directs us back to the principles rather than the rules. So now we'll begin with Converging U.S. GAAP and how it is a better decision than converting. We'll start with the definition, convergence. This means that the U.S. FASB and IASB would continue working together to develop high-quality, compatible accounting standards over time in the best interest of the capital markets. Over time. This is going to take a lot of work. As we've already seen, it's not combined yet, and there's been a lot of work on it, but that jurisdiction would closely align some or all of its local GAAP with IFRS. The convergence can be achieved by either incorporating those specific standards from IFRS or modifying the local GAAP to more closely resemble IFRS. To mitigate some of those transitional changes, U.S. firms might have to be able to leverage the knowledge gained from overseas firms that have adopted IFRS. So we're going to use information as companies have moved across to IFRS and learn from them as the United States. Leveraging that knowledge from overseas firms could potentially result in lower costs of conversion. So one, we're already solving one of our assumptions. Similarly, those U.S. regulators may also be able to learn best practices from the overseas counterparts and help implement a smoother transition. One example that I read about was China. IFRS is neither required nor permitted, but the Chinese accounting standards, which is the CAS, has substantially converged with IFRS. To a significant degree, IFRS has customized to a more easily understandable format for the Chinese markets. So being able to work together in order to build a more understandable format for both Chinese markets and the IFRS, so everybody is together. Now, I understand in the US that it's believed that the GAAP is the gold standard, and as the certain level of quality will be lost with the full acceptance of IFRS. But we do have to be able to understand that we deal with so much overseas investments or just companies, competitors, everything that we need to be able to compare those financial statements and work on the same level. Comparing with the normal business operating cycle for individual firms in the economy by converting to a new standard arguably will require greater resources. That's going to be the time, it's going to be the humans that we use, the financial stability that we have. But the SEC states its belief that a single set of high-quality, globally accepted accounting standards would benefit those U.S. investors in its continued encouragement for the convergence of U.S. GAAP and IFRS. Now, by doing so, the SEC chair believes that the convergence of FASB and IASB will enhance the quality and comparability of financial reporting. We all know how important those financial statements are for everybody, our investors, our own companies, our stakeholders, our shareholders, everybody. Those financial statements provide economy-wide benefits to firms and investors through the accurate information. So one way that those benefits are realized is through the efficient allocation of capital between investors and firms. So if investors rely on that financial statements to make informed decisions on how to best invest their savings, we need to be able to have a greater need for the transparency and the accountability in the financial reporting that we are doing. Now, in agreement, the chief accountant of the SEC acknowledged that there is continued support for the U.S. for a single set of standards, but one, there's little report for the SEC to provide an option allowing domestic companies to prepare their financial statements under IFRS. And then two, there is no support to have the SEC mandate IFRS for all companies. So the SEC is not too excited about it. But according to the article discussing the conversions and potential adoption of IFRS in the US that I read on the FASB website, even under a single set of high-quality financial standards, financial reporting may vary among firms and industries. So this is why converging US GAAP with IFRS is better than overall converting to IFRS. Now, it is important for a U.S. capital market participant to be financially bilingual. We understand that. We have to be able to speak both IFRS and U.S. GAAP. And with that study done, and that showed that a lot of our professionals are very uneducated in IFRS, this builds a very high wall for us. For example, stakeholders, they need to be able to require the comprehensive knowledge of the accounting differences. Those differences could include our tax requirements, merger and acquisition conventions, market regulations, or legal practices. They need to be able to understand the implications of existing and evolving all of that information. Since the companies are thousands of miles apart, being able to carefully assess this complex information is important for us. And another transitional issue of adopting IFRS is the financial statements at first might be misrepresented either intentionally or unintentionally. Because that pursuit of adoption of IFRS undoubtedly leads to changes and concerns about the costs of doing so with the perceived benefits. However, convergence with IFRS would mean better quality information, which would offer better communication with our shareholders and our stockholders, and then ultimately lead to lower costs of capital. In consideration with our globalization of capital markets and the growing cross-border economic transactions that we have throughout overseas or in the United States, we need to be thinking about that financial information. Financial information could finally be compared across the board to enhance the investment decision-making. In addition, the learning curve of trying to understand two types of accounting standards, both GAAP and IFRS, could lead to unintentional mistakes. But if the financial statements errors are significant, then the business could reissue the financial statements. A significant financial misstatement could lead to a decline in a firm's stock price, which then makes it difficult to raise capital. And if several companies have to restate their financial statements, investors may lose confidence in the overall U.S. capital markets, or at least temporarily. This is why we need to discuss more on converging both of them rather than using two completely different standards. If we, as a U.S. company or a firm, are using GAAP, and then our counterpart is using, or our investor is using IFRS, and we make an unintentional mistake because the financial statements are different, they're completely different in so many different aspects, then we could be losing so much money overall in the capital markets in the US, but then also losing our confidence from our investors. So in turn, loss of confidence by our investment community could increase the cost of capital or limit our availability of credit for US firms. The investment community might discount the value of firms' equity or even demand higher premiums for the debt issued by the firms. Now, in addition, a single set of global accounting standards that address the needs of both the less sophisticated smaller companies, and the more sophisticated larger economies may serve the best interests of U.S. investors and firms. Certain U.S. issuers without significant customers or operations outside the U.S. may resist IFRS because they may not have a market incentive to prepare IFRS financial statements. This is why we would have to work with those. Now, since an outright move to international standards is off the table, FASB and IASB should continue to focus on improving the quality of their standards while, if possible, reducing differences between IFRS and U.S. GAAP by converging the standards. Now, on the other hand, let's talk about converting. Converting directly to IFRS is better than converging what we just talked about. So we'll begin with that definition of converting. A lot of the articles use adopting as well, so I may be corresponding those two words together in this discussion. But converting overall means that the SEC sets a specific timetable when publicly listed companies would be required to use IFRS as issued by IASB. So the main difference already is that converting, they need a timetable. They need to know exactly when everybody is going to be listed and be required to use IFRS. The adoption is one approach to accept IFRS without any modification as set by IASB. So first, let's talk about the transition options from GAAP to IFRS in completely converting. The first way is for SEC to choose a specific date that all public companies would be required to report under IFRS. This approach might be the least confusing and most straightforward for firms and investors, but it also presents a particular set of challenges. Not all firms may be able to adhere to a specific date because of a specific amount of resources. So you have to think of the human resources, the technology resources, the financial resources, everything within a firm. If they might not all have that type of money right now in order to build and go from GAAP to IFRS, they have to be able to find a different way for that. So the second available way is to implement IFRS over several years based on the firm revenue size or by the industrial segment that might allow stakeholders sufficient time to adapt to those new standards without significant disruption in their firms or the economy. Being able to phase in IFRS based on that firm revenue size with larger firms adopting first could be justified on the grounds that firms with higher revenues are able to absorb more readily than smaller firms. Then it gets better. Further, there will be significantly more smaller firms than larger firms, of course. There's a ton more. There's only the big four, or a few bigger than that even, or a little bit less than that. But it will allow more time for the supporting companies to scale up their resources to support the transition. So as those larger companies and larger firms are being able to absorb the cost, they have a lot more money and more time and more resources in order to convert from GAAP to IFRS, then we will have the smaller firms learn from those successes and failures of the larger firms and identify ways to reduce costs of conversion. So we can get everybody to IFRS. It might take a little bit of time, but we also have those dates where it's specified for the different revenue, for the different firm revenue size. I apologize. So the potential for investor confusion exists. However, during the period of transition, as firms within the same industry could be reporting under two different standards. So as those larger firms are going to be starting to convert to IFRS immediately, the smaller ones are still going to be using GAAP until it becomes their turn, in a sense. So that is one downfall for that. Now, another option would be to implement IFRS by specific industries over time. Industry-specific implementation would be easier for investors and other stakeholders trying to evaluate the performance of a company among its peers. So if in auditing banks, if they all convert at the same time, then those stakeholders that use that information and the investors that use that information, it'd be a lot easier to evaluate the performance of those companies. One example I did read, though, considered an individual who is specialized in auditing banks. Arguably, the knowledge of the banking industry is not so readily transferable such as the natural resources industry. So this approach might present challenges to smaller firms because they might not have this know-how or the financial resources to convert simultaneously with the peers that have higher revenues within the same industry. So after we went over those three different changes and different types of transitioning, I preferably really like the phasing in based on the firm revenue size. So then those smaller ones would have that time in order to build up the resources, build up the knowledge, build from the experiences of the larger firms, but still be able to have that same transition to IFRS. Companies with subsidiaries in countries that require or permit IFRS may be able to use one accounting language company-wide. So according to PwC, which is PricewaterhouseCoopers, when financial statements must be converted or reconciled to IFRS, or conversely, from IFRS to GAAP, the complexity of the deal intensifies. For an example, imagine a non-US company that has historically used local GAAP planning an IPO, an initial public offering. They decided to continue with using that local GAAP and reconciling to be on time and cost efficient, as we'd all like to be. But as a foreign private issuer, the company could have decided to change its primary GAAP from local to IFRS. This would have reduced the historical periods and aligned that reporting requirements of the SEC. That would have also eliminated the need for reconciling to US GAAP in the future filings. So both buyers and sellers must conduct a rigorous due diligence to ensure that cross-border risks are identified and included in the purchase agreement. So they all need to be understanding on what they're going to be doing. Now, in regard to the cost of adopting IFRS, there was created an IFRS 1. This is the first time adoption of IFRS, which is a standard that helps companies transition to IFRS and making it more cost effective. It eases the burden of challenges of fully adopting IFRS by going step by step. So it begins with identifying financial statements. Then it goes into preparing the balance sheet at the date of transition. Next, we consider optimal exemptions. Finally, we make our disclosures to explain the transition. So our really current updates, and there's also a lot of amendments to this first-time adoption, but it's going to relieve a lot of the pressure for those smaller companies during the full transition, and even the larger companies, because everybody will have that help in order to get through it all. A transition to IFRS can be long and complicated, but by learning from experiences and conversions in other continents such as Europe and Asia, there are some challenges that are consistently underestimated in the differences between IFRS and GAAP. One of those is consideration of data gaps. Many require more information that wasn't required under GAAP. Of course, there's going to be a lot of differences between IFRS and GAAP. The next is the consolidation of additional entities, because the principles are going to differ in regards to if they're deconsolidating or consolidating those entities. A third difference is the consideration of accounting policy choices. IFRS standards allow companies to choose between alternative policies, so companies should selectively, carefully choose the policies that they want to use. A high-quality Uniform Global Accounting Standard, or IFRS, or another internationally accounting standard must provide economy-wide benefits for the United States. Firms might benefit from those easier access to global capital markets because that uniform standard would make it easier for investors to compare everyone's performance under one standard rather than different standards. Now, there are many implications for the U.S. investors and firms. The main one that I really liked was the high quality, I already said that, whoops, so sorry. Now, if firms choose to issue financial statements under both standards, during the period of transition, there are going to be costs to reconcile both sets of financial statements and provide those disclosures for investors under the different income and asset valuations for each standard. Firms must also decide if the benefits outweigh the costs of having both sets of financial standards audited or just having one financial statement audited. So that is why it is way better to convert to IFRS rather than converging GAAP with IFRS. With the continued global adoption of IFRS, it means that the impact on multinational U.S. businesses will only grow stronger. As additional countries permit or require IFRS for statutory reporting purposes and public filings, there are over $6 trillion of U.S. capital invested in non-U.S. securities. It is a vital information that U.S. investors keep looking overseas for investment opportunities. So with all of this completed research, I fully believe that converting to IFRS is more beneficial for the United States. Even with the increased cost of retraining our individuals and companies, along with the burden of applying our IFRS retrospectively, but with the help of IFRS 1, that first-time adoption, it will provide accommodations needed to make the adoption cost-effective. There have been many amendments to the IFRS 1 arising with new standards as they become effective, and currently there are about 19 exemptions to ease the burden of retrospective application. So with all of the research today, I do believe that it is more important and more useful in order to convert IFRS rather than converging, because of all the ways that it's going to help with the, checking my time, with companies overseas. In regards to everything, we want to make sure that both of our buyers and our sellers are going to be on the same page. We want to know that our non-US companies are using, oh my gosh, I'm stuttering so much right now. Thank you.